We begin today with a moment that stops the financial world in its tracks. Alan Greenspan, the man who served as Federal Reserve Chair and steered the most powerful central bank on earth through the dot-com boom, the devastation of 9/11, and the early tremors of the 2008 financial crisis, has passed away at the age of 100. His tenure from 1987 through 2006 defined what modern monetary policy could look like, part science, part art, and wholly consequential. Markets are trading this Monday with the S&P 500 at 7,476 and the Nasdaq 100 at 29,625, reflecting a world shaped, in no small part, by the frameworks Greenspan built. Greenspan's passing marks the close of a chapter that reshaped how central banks communicate with markets, manage inflation expectations, and respond to systemic shocks. He served nearly 2 decades at the Fed's helm, longer than any chair in the modern era, navigating crises that would have broken lesser institutions. Today, the 10-year Treasury yield sits at 4.49%, up 94 basis points on the session, while the VIX has ticked to 16.85, a 2.74% rise that signals modest but real unease in the options market. Gold futures are holding near 4,212.40, essentially flat, as investors process both his legacy and the current macro environment simultaneously. The reason Greenspan's death resonates beyond a simple obituary is that his intellectual fingerprints are still embedded in today's policy architecture. His doctrine of preemptive rate cuts, his preference for letting asset markets run and cleaning up afterward, and his infamous irrational exuberance warning. These were not just phrases, but entire schools of thought that current Fed governors still debate. The modern Fed's dual mandate execution, its forward guidance apparatus, and its crisis response playbook all owe something to Greenspan's experimentation. Understanding that context helps investors appreciate why today's 4.49% 10-year yield and the Fed's current posture feel so historically weighted. In terms of direct market impact, this is not a catalyst that moves earnings models or changes rate expectations overnight. But the reflexive flows are worth tracking closely. Long-term treasuries, the 20-plus year Treasury ETF, could attract modest safe haven demand as institutional investors reflect on systemic stability and Fed institutional continuity. GC equals F, gold futures at 4,212.40, is the other traditional refuge, holding relatively steady with only a 0.28% dip today. The financial sector ETF, carries mixed sentiment. Greenspan's legacy is simultaneously credited with crisis prevention and criticized for enabling the very bubbles that later burst. Meanwhile, the Nasdaq 100 is surging 2.51% on its own momentum, largely detached from today's historical footnote. The key levels to monitor heading into the week are well defined by today's snapshot. The 10-year Treasury yield at 4.49% is the spine of everything. If it moves meaningfully higher, pressure builds on rate-sensitive equities and bond ETFs, like long-term treasuries. The VIX at 16.85 is not alarming on its own, but a continued grind higher would suggest the market is quietly repricing uncertainty, not just mourning a legend. Gold at 4,212.40 serves as the canary for systemic anxiety. A decisive break above that level would signal real defensive positioning. Watch also for any Fed official statements that use Greenspan's passing as an opportunity to reaffirm institutional independence. Those communiques move markets. Greenspan's passing carries enormous symbolic weight, but no immediate directional signal for portfolios. The market is efficiently separating sentiment from strategy. The S&P 500 trades at 747.62, and crude oil is the real mover today, down significantly for entirely unrelated reasons. What today does invite is a deeper reflection on Fed credibility as an institution, not just as a personality. Central bank independence, the very pillar Greenspan both strengthened and occasionally strained, remains the bedrock of the bond market's pricing. That's the full picture on Greenspan's historic passing and what it means for markets right now. Coming up next, a story with direct and immediate implications for energy traders and crude oil prices. Shifting now from macro headwinds to a story with direct implications for the retail sector. A new survey from the Human Rights Campaign is revealing a measurable realignment in consumer spending, and it is pointing directly at 3 of the largest retailers in the country: Target, Walmart, and Amazon are among the brands that LGBTQ+ consumers say they are actively moving their wallets away from, citing perceptions that these companies have retreated from diversity, equity, and inclusion commitments. This is not an abstract sentiment survey. It describes behavioral spending shifts that, if confirmed in quarterly data, land squarely on comp store sales and operating margin lines that Wall Street already watches closely. The Human Rights Campaign survey finds that LGBTQ+ consumers are reallocating spending toward companies they perceive as maintaining genuine Douglas Emmett commitments, and away from brands seen as scaling back those programs. The tickers directly in the crosshairs are Target, Walmart, and Amazon, three names that, in aggregate, command an enormous share of everyday discretionary and staples spending in the United States. This matters as a quantitative setup because sell-side equity research has not historically modeled LGBTQ+ consumer cohort behavior as a discrete downside variable, meaning current street consensus on comp store sales at these names does not price this risk at all, leaving models potentially stale heading into Q2 earnings season. The timing of this survey landing in the market could not be more consequential. The VIX is sitting at 16.85 today, signaling elevated volatility and fragile investor psychology in the broader tape. The 10-year Treasury yield is at 4.49%, rising on the session, which directly compresses the valuation multiples that discretionary retail stocks trade on. Higher discount rates punish forward earnings most severely in cyclical consumer names. Against that backdrop, any new downside vector on consumer demand is amplified. Retail sentiment was already cautious. This survey introduces a cohort-specific flight risk that models have not absorbed, arriving precisely when the market has the least tolerance for guidance uncertainty. The primary exposure sits in consumer discretionary. Watch XRT, the retail ETF, as the most direct sector vehicle for this thesis. Target faces support risk near recent lows if comp store momentum turns negative. Walmart confronts near-term resistance on its multiple if the consumer thesis deteriorates further. Amazon is a nuanced case. The risk is not just e-commerce revenue but the higher margin advertising and marketplace segments, where brand perception drives seller investment and consumer engagement simultaneously. Disney is also named, exposed to the same perception dynamic in its streaming and theme park verticals. The Russell 2000, tracked via the Russell 2000, is up modestly, reflecting small-cap discretionary names already pricing margin compression risk from a potential large-cap guidance cascade. The critical near-term catalyst is Q2 earnings season for Target and Walmart, where management commentary on consumer cohort behavior and any revision to same-store sales guidance will either validate or dismiss this survey signal. If LGBTQ+ spending reallocation is measurable in reported comps, expect analysts to begin building a discrete consumer flight haircut into forward models. That repricing alone could generate meaningful multiple compression on exposed names. On the upside scenario, if the survey overstates actual behavioral shift and spending patterns hold, Target and Walmart benefit from a reprieve on guidance anxiety, and the Nasdaq 100's 2.51% gain today sustains. The S&P 500 at 7,476 lacks strong conviction higher with the VIX elevated. Discretionary guidance cuts would be the catalyst that breaks that level decisively. Here is the core insight that sophisticated retail investors need to internalize right now. The HRC survey introduces a consumer segmentation risk to Target, Walmart, Amazon, and Disney that current sell-side models have structurally underweight. They assumed LGBTQ+ demographics stayed sticky to value and convenience, and this data directly contradicts that assumption. If this reallocation shows up in Q2 or Q3 comp store sales, the street will reprice guidance on these discretionary names downward, and XRT faces meaningful multiple compression. Those are the two stories that matter most to your portfolio today. Full breakdown is up, and now you have the framework to trade both of them before the rest of the market catches up. If this kind of deep dive market analysis gives you an edge, hit subscribe right now and ring the notification bell. We break down the stories that move your money every single trading day, before the open and after the close. Don't miss tomorrow's coverage.